There we go. Okay, we should be all set. All right. Well, good afternoon, everyone. My name is Raisa Lear. I'm the Executive Director for Business Affairs here at the University of the District of Columbia. I am pleased to be bringing you greetings today from the university and to welcome you to this Let's Talk Money webinar, the first in a series of financial literacy and financial empowerment seminars that the university plans to bring. The university is pleased to partner with the District of Columbia Department of Insurance, Securities, and Banking on this seminar. And I would now like to introduce our facilitator for this session, Ms. Michelle Hammonds, who is the Director in the Office of Financial Empowerment and Education. Michelle, thank you so much for your time today as facilitator. We really look forward to this seminar. And with that, I'll hand it on over to you.
All right, thank you so much. It's a pleasure to be here with everyone today. As Raisa mentioned, I am the Director of the Office of Financial Empowerment and Education at the Department of Insurance, Securities, and Banking here in the District of Columbia. I send greetings from my Commissioner, Karima Woods, to share with you all some information on this conversation that we're having today. Let's talk money, debunking myths about money. So this will be a provocative conversation to get you thinking about money and really thinking about what are some of the taboos that stop people from talking about this topic. When I was preparing for this presentation, I actually just did a Google search just to kind of refresh my memory and to really think about some of the things that are slowing people down from having this conversation. Many times people feel as though this is a conversation that they can't have because they don't have money, or it may be a conversation that they feel uncomfortable with. And so what we want to do is take away all of those taboos so that we can really have open and honest conversations about how to start to build wealth in our communities as we are engaging with the UDC community overall. Now, I did have some folks here on the panel with me that I would like to take some time to introduce so that you can be familiar with them. And I'll start with one of our first speakers. It's going to be Odingus Ayabuke.
Yes.
He is an author. He is a former UDC student, as well as an overall great participant in the community. So without further ado, I'll turn it over to Odingus to tell us a little bit about yourself, as well as some of the projects that you are working on currently.
Hi, everyone. Thank you, Michelle, for this platform. Thank you, Leah, for inviting us all, the panelists, to this discussion. My name is Odingus Ayabuke Jr. I'm an author, I'm a philosopher, I'm a content creator, and more. Every day I'm becoming my greatest version and just creating from my own being. So I did go to UDC. I graduated in May of 2011 with an econ degree. Over the years, I've been trying to figure out how can I save my money or invest it and get a return. My very first experience with personal finance was when I was at school, UDC. I took a personal finance class, and my professor at the time, I believe his name was, I think, Peter Martin. I may be wrong, but he actually opened my eyes to personal finance. And after that class, I told myself I would never spend money unnecessarily on things that I don't need. And I would try my best to learn about financial stock markets. Fast forward to 2020, we had a major event, the pandemic. I realized then that there were two important lessons that I learned: that your finances and your health must be perfectly secured. Because even those who had businesses lost their businesses because of events that they were not able to control. So hence, I developed, I came up with the content and I said, you know what, I need to put this into a book form from what I've experienced. And that's why I wrote the book, 9 Money Pills That You Should Swallow If You Truly Desire to Become Rich. So.
All right. Thank you so much for that and sharing that information with us. And we look forward to this engaging conversation. I'll move to our next panelist, Miss Muriel Gar. She is a radio host of 2 shows, Champagne and Credit, as well as Beyond the Bling, as well as a seasoned financial services representative for a financial institution. Without further ado, I'll turn it over to Ms. Muriel Gar to share a few words and give a little bit of background about her thoughts on money and finance.
Thank you, Michelle. And I also want to thank Raisa and the other panelists for the opportunity to have this conversation. Let's talk money. And I also want to thank all of you that are actually participating in this virtual session today. As Michelle has noted, I am Muriel Gar, and I'm the host of 2 radio shows, both of which have to deal with this conversation about money. The fact that I host 2 radio shows is not really the topic of conversation, but what is the topic of conversation is how that came to be. And it basically came to be as a result of spending time with individuals, having conversations that they normally wouldn't have during the course of the day, or even on the weekends with their girlfriends, or hanging out for dinner, or having a cup of coffee, playing a game of tennis, or a card game. It was obvious that those basic topics around pay inequity, credit scores, access to credit, credit approval process were not taking place at the dining room table. In fact, many of us, particularly women, were not having those conversations at all. And we were subject to a system that treated us in a way where we were often asking the question why without really understanding the background to what caused the issues. I was also driven to dive even deeper, to use media to educate people about money during the 2007 and 2008 housing crisis. What became very obvious to me is that not only were a disproportionate number of Black and Brown people losing their homes, but in addition to them losing their homes, financial institutions were not creating an opportunity to have a holistic conversation around money. The conversation was sort of tailored to the business of money. And most individuals don't even understand that the business of money is not just isolated to financial institutions, that the business of money also pertains to each one of us. So over the years, I've strived to have straight talk about this conversation called money, to help individuals understand some things that they may not have even really realized in their generation. One, did you know that women did not have equal access to credit until 1974? If we were having this conversation in 1973, I as a woman would not be able to get a credit card, a car loan, or even purchase a mortgage if I did not have a male co-signer on the application. Did you know that credit scores alone do not determine that you're going to get the best pricing when you go to actually apply for a credit card, a car loan, or a mortgage? Did you know that institutions or lending entities have credit policies? And within those credit policies, there are ranges of what they can charge as far as interest rates based on a credit score. Did you know that you and your neighbor could be living in the same house, and your neighbor could be paying a considerably amount less for the mortgage for the same property and you not even know it? Or did you know that your coworker sitting across from you may have the same credentials as you or may not, but they may be earning considerably more than you do? All of these things impact our ability to create wealth so that we have money to pass on to the next generation. So I am looking forward to engaging in this thought-provoking conversation with my colleagues on the panel and with Michelle moderating, and your questions to getting you to the goal of creating financial security. Thank you, Michelle.
Thank you so much, Muriel. And last but certainly not least, our last panelist for today is Paul Yablonsky. Excuse me, I think I butchered that last name and I practiced so hard. But Paul comes to us from the TIAA Institute and has a lot of background in research and information on financial literacy as well as financial empowerment. I would like to welcome Paul to say a few words as we get started and hear from him.
Thank you, Michelle, and you were close on the name, so no harm, no foul as far as that goes. Good afternoon, everyone. As Michelle said, I'm with the TIAA Institute. I'm a senior economist with the Institute. So what that means is that, yeah, I am the I'm the research nerd. That's on the panel today, but I promise to keep those tendencies in check. With that said, I would like to share a few takeaways from our ongoing research regarding financial literacy, financial well-being, that I think are germane to the conversation today and the program that UDC is rolling out. So my first, number one, would be that the reality is most adults in the US have a low, sometimes very low level of financial literacy. That's most adults. By financial literacy, just to be clear, I'm talking about knowledge and understanding that enables sound financial decision making. So what this means then is that most adults operate in a realm of personal finances really with a significant handicap is what it boils down to. The fact that this is the reality for most of us isn't a criticism, isn't an indictment. It's our reality that we need to address. And honestly, it really should be no surprise. After all, where do we think most individuals would have gotten this requisite knowledge, this requisite understanding? As the title implies, we don't talk about it, but more importantly, historically, where did individuals have access to the information? Where did they learn about it? The reality is that only 30% of US adults have participated in a financial education class or program. 60% say they've never been offered one, either in high school, in college, or in the workplace, or an organization in their community. That tide is turning. As Angus said, he had access and took a class on personal finance in college, and that is a shift, but it's still a reality that most individuals have not. My second thought, following up on that, is that what we know, in particular from the research, is that financial well-being is linked to financial literacy. Greater financial literacy generally translates into higher financial well-being. Lower financial literacy is generally associated with lower financial well-being. And here I'm just not talking a dollar figure on a bank account or something like that. I'm talking about real life experience, ability to make ends meet month to month. Do I have emergency savings? What's my state of financial fragility? Am I debt constrained, et cetera? And so this is why we care about financial literacy. Not for the sake of the knowledge itself, because of what it translates into. Now, to be clear, we should be under no delusion that increased financial literacy is a panacea, that it's this magic bullet solution for poor financial well-being. It's not. Clearly, other things matter. Clearly, resources matter. Access and opportunity in a financial system matters. But so too does the ability to make sound, appropriate financial decisions. And one could even argue that this is particularly important among those who have modest incomes, modest level of resources with which to work, simply because there's less wiggle room there. Third point, improving financial well-being, improving personal finances it appears to be a point of increasing focus among many individuals as we are working through and inevitably move forward from the pandemic. In our work, we see 40% of adults say that the economic uncertainty, that environment created by COVID, has motivated them to increase their financial literacy. And I think it's really noteworthy that this sentiment is particularly strong among those with lower levels of financial literacy. So I just would stop by saying, hey, given my points 1, 2, and 3, my fourth and final here would be that for these reasons, I think it's absolutely fantastic that UDC and the Office of the Mayor, the district, DISB, if I have my initials right, Michelle, are sponsoring this program and rolling it out through into next year. And I'm genuinely delighted to join Michelle, Muriel, and Odingas on this panel.
Thank you all so much. As you all can see, we have a variety of experiences on this panel, but I think it adds to a rich conversation that we'll get started with. And I really am just pleased that we were able to put this on in partnership with the University of the District of Columbia. And so to the panel, I have this first question that I want to really offer to you on and ask. Why do you think it's important to have conversations about money throughout one's life? Many people on this discussion are in different points in their lives. So why is it important to really have this discussion? And I'll start with Paul and go back through the panel the opposite way. Paul, Muriel, and then Odingas.
Usually alphabetically, I get to go last, Michelle, but
I like to keep you on your toes.
yeah, you are. You are. Basically, the reality is we're always learning. Through the course of life, we're learning. We never reach a point where we know it. In particular, that applies in the realm of personal finances and financial literacy. Going back to an original question, I have nothing to verify, but I think one of the reasons people are reluctant to talk about money is because they feel I don't necessarily know what I'm talking about. And so talking is where we're learning. In a classroom setting, in conversations with friends, in conversations around the dinner table. That's where our children are too, and where they're learning and seeing how mom and dad, grandma, grandpa, aunts and uncles, etc., deal with money and manage money and think things through. And we learn from one another. But we also have to be trust and verify. Just because Uncle Joe says it, that didn't mean it make it right. We might want to look into that. But it's how we continue to learn, and our financial priorities and objectives will clearly evolve over time. Dingus is, young, early career. I'm old, late career. I'm more focused on retirement realm. He's more focused on getting started. The needs and priorities are different, and they evolve. So you continually have to be talking those things through with family, with friends, with financial professionals that you trust.
All right. I think, Paul, you hit on some really key notes. I don't know if Muriel or Odingas, you have some additional things to add.
Yes, I think what Paul just said makes he makes a very good point. I can speak for myself. Growing up, no one taught me about personal finance. I was told, go to school, get good grades, hopefully find something that can fetch you, that can get you some money after college. Just don't pile on student loan debt, get a job, and you'll be set. So it was like an ABCD type of thing. But when I went to school, of course, I was still not too savvy with money. It was when I got out of school and I faced the real world, I began to see how important money is and why I needed to invest it, save it, spend less, and the whole shebang. So over time, I began to see not just talking at the dinner table alone, but how we put money usage into practice. We can talk about it, but we have to also live it. Our lifestyle, what we do when we earn our money. How do we spend it? How do we save it? How do we invest it to get more? And also, I want to point this out. A lot of times people talk about money. I think we need to have discussions of producing things that have intrinsic value that we can market and sell as well, so that we don't always have to rely on going to get a job or applying for a job. We can become the job or we can become the business. That's what I have to say.
You know, Michelle, what I would add to this, while money was not a conversation around the dinner table in my home growing up, ownership was. And so that's key. Both of my grandparents on both sides owned real estate. I was raised in a home that my parents owned, not in an apartment. Entrepreneurship was very evident in the family. But what was missing was the why. And the why is always important. You know, people say, well, why is it necessary to own versus rent? And then some would say, he who owns the land calls the shots. When you have ownership, you have a role in actually what happens to you and what happens in the community around you. Also, when you have ownership, you are investing, continuing to invest in you versus investing in someone else. Oftentimes we don't have these conversations because particularly in some communities, we are comfortable with presenting a facade. We want people to think that we are at a certain place economically. So we're not going to let them know that we really are not po, but po, and that we are one day away from eviction because we want them to think that we've got it all together. And so if we sit down and have a real conversation, then the image that we've tried to paint, not only outside of our families, but inside our families, will become distorted. And there's this sense of self then that's tied to that. We've got to move beyond that. And a lot of that sense of self, particularly for Black and Brown people, goes back decades and centuries as to how we were taught or trained to think of ourselves. But in order to get the financial security, we've got to be willing to have those conversations, not only around the table, but in the circles in which we actually exist. And we need to seek to be around people that are financially secure. And that may mean that we need to cut the umbilical cord from those that are just living from paycheck to paycheck, who have never picked up a Wall Street Journal, who don't know what a stock ticker is, wouldn't even take the time to look at look at Bloomberg because the Real Housewives are on. We've got to change our circles to change the conversation so that we can change the financial trajectory of not only our lives, but our children's lives and our children's children's lives.
Thank you for sharing that, Muriel. They say that you are the people that you surround yourself with. So I've heard that many times. So as we are really trying to think through in our communities, how do we engage and have these conversations, really consider who you're having these conversations with and who is in your circle. And don't be afraid to pull somebody up with you into that circle and into that conversation. So thank you for adding that. And you kind of lead me into the next question that we have on our list is these pitfalls that people fall into by not having these conversations. So I'll turn it back to Muriel just because we were kind of on this groove. What are some of these pitfalls that you think that really inhibit or stop people when they're having these conversations. You know, we're really talking about in our circles. If we don't know, you don't know what you don't know. But
Oh my goodness. Uh, so because this is an hour session and we could go over pitfalls for 2 hours, let's just go real quick. We buy more car than we can afford because we want to impress Mary, Peter, Paul, and John, and they're not paying $4 a gallon to put gas in our car. We buy a house that we can't afford with no furniture. We can't pay the electric bill or the water bill because we're more concerned about what they're going to think. We're going to be advertising for somebody else buying luxury clothes that we definitely can't afford because we are way too proud to go to a consignment store to shop because that's beneath us. And by the way, I got a 4-year degree. And why would I want to do that? We go to a college or a university that we really can't afford because of the cliche that goes to that college or university. How dare we want to go to UDC? Oh my God, even though the education is superior to some others and the cost is considerably less, but we're too busy wanting to impress others. And then we get into this pitfall where we are busted and broken and broke, and it's everybody else's fault. It's the man's fault at that point that we are busted and broke because the man didn't take the time to teach us or to educate us. Now, Paul talked about this whole thing about financial education, and 30% of the population have participated in some type of personal finance class. And while from a book sense standpoint, I'm with Paul, I'm tracking, I'm feeling him. But in the hood, grandma never went to a financial education class. But if you ever got into a bind and needed some money, grandma had money either in a Bible, somewhere in the coffee table, or in her bra. She knew how to manage her money at all times, even if she didn't have a 3rd grade or 6th grade education. So she may not have book sense, but she had common sense. And so we need to, part of this is personal responsibility and accountability. I'm not going to say the system's not rigged against us because the system's got some issues, but we also have to move away from the brainwashing of pleasing others and spending money that we don't have to look like what we are not.
okay, and I'm gonna turn this back over to Odingas because I think this may come into some of the comments that you mentioned, and especially in your book, the 9 pills, financial pills that people should swallow.
What I have to say is pretty much what Mira has already stated very clearly. To add to what she has already said, which I'm in total agreement with. I will say some pitfalls are when we carry on so much debt. Mira mentioned student loan debt. We go to a college that we cannot afford just because of the name. Obviously, over the years, we've seen how that has turned out for a lot of people. A lot of people are carrying on $200,000 debt because they went to an Ivy League school that they couldn't afford. They come out and get a job, and then they have to pay back that debt because student loan debt is not forgiven. And then we have credit card debt where people just shopaholics. They buy things for friends that probably don't even like them, don't care for them, or even family members. We are in a festive season, so there's gonna be a lot of shopping going on. I mean, personally, me, I don't celebrate no holidays. I believe if I can afford it, I get it. If I can't, I don't have to buy it. So my philosophy is you don't have to keep up with anybody. You don't have to keep up with the Joneses, the Rockefellers. I just say cut your coat according to your size, spend less, save and invest more. Because at the end of the day, why would I patronize someone else who doesn't care about me? Why would I purchase something for someone else who is not going to reciprocate back in return when I need them to buy for me or just, help me in some areas? So yes, of course, there are people who have financial literacy because they went to different personal finance classes and they got that knowledge. And then the people who just have common sense based upon the experiences, life experiences that they've acquired over the years. They know how to save their money. They know how to invest a little bit. They may not be literate in the financial stock market, but they know how to manage money. And in that sense, some of the pitfalls that we just described does not affect them too much. But those who are off course, who are just like floundering in debt after debt, they will face some of the pitfalls that Muriel and I are just describing.
Thank you for that, Odingus. And I want to move to Paul, because Paul, you had a lot of this data kind of back up some of this conversation. When we're thinking about some of those pitfalls that we may have seen in the past, or when we're thinking about what's inhibiting people from doing this part, saving more, spend less. How do we start really getting this conversation into folks' head? Because these financial classes are important. When you mentioned financial literacy was linked to financial well-being, how do we start taking people to that place?
Well, it starts at dinner tables, but depending on the family situation, that may not be the best source if the adults around the table aren't financially literate themselves. And piggyback on a point Muriel made, I'm not talking about textbook knowledge, we're talking functional knowledge in terms of financial literacy. A lot of it applied common sense and in practicing that. And so it's important for individuals to be picking that up and exercising it. Piggyback off of Dingus too and take it to the point of this is really important early in life in particular, where you're just starting out, you make a lot of initial decisions and stop and think. A lot of our initial decisions, we don't even view them necessarily as financial, but they are, and they're sticky. They're hard to undo. So get a job, I move somewhere. Where do I live? How far away? Do I need a vehicle? What do I buy? If I get into an apartment that I really can't afford, I'm stuck there for 12 months. Can't undo that 2 months from now when it doesn't add up. If I buy that car, I owe it for the 5 years to 6 years, whatever the loan is. So these things can't be readily undone. So people, at any age, but particularly at younger ages, need to think hard about these basic lifestyle decisions that they're making right off the bat, because they set a course, good or bad, and courses once you're set out, they can be sometimes hard to course correct, if you will.
Thanks for adding that, Paul. And I'll have a few more questions for the panelists, but I want to also address our attendees. As you all know, you are in listen only mode, but we want to make sure that we can answer some of the questions that you all have. So as we're finishing up the panel conversation, please think what questions you might have for the panelists and put them into the chat so that we can make sure we can engage and cover the conversation and the topics that are of interest to you. So I'll be looking for that in the chat. You can easily add those questions that you might have. And so I'm gonna go back to the panelists and just ask you a couple of more questions, and I'll kind of do it one per person so that we can cover a lot of these particular topics. But one of the questions that I asked to the panelists is the word budget, and I want to turn this back to Odingus. There were two questions. What do you think people don't like the word budget? Is it a bad word? Is it like diet? What are we thinking about here?
Okay. Wow. Budget is not a bad word. Matter of fact, the United States has, they always have a yearly or maybe a decade budget. Every successful economy must have a budget. So why shouldn't you have a budget as an individual or a family man or a family woman or family in general? Personally, I think budgeting is one of the most effective ways we can monitor how much money we're spending, how much money we're saving, how much money we are investing, it keeps you disciplined of some sort. It keeps you disciplined. I think when you keep track of how much you're spending, how much is coming in, what you're doing with your expenses, how you're saving, how you're investing, it just keeps you grounded a bit. It keeps you focused on what you need and what you don't need, or what are your wants versus what are your needs. I think budget, from my point of view, is a very good thing that we can all have, and it helps us keep track of what we are spending and what we're saving.
All right, thanks for that. And Muriel, does income equal more wealth? What are our thoughts on that?
Well, it's interesting, Michelle, how you pose the question. Um, so I'm gonna restate the question. I'm assuming you're saying, if I make more, does that mean I'm going to be wealthier?
Yes, yes.
Because income actually could correlate to wealth, but just because I make more doesn't mean I'm going to be wealthy.
Okay.
Because in order to be wealthy, we have to be disciplined, and that discipline starts with conditioning our taste buds. I'm going to go back to something that Paul said, because when we're saving more and spending less, that's a behavior. So sort of like when they say, when you have an infant, if you start feeding them certain foods, their taste buds will actually go towards that certain taste. And as they get older, they won't go to eating things that are not healthy for them. The same behavior has to go with how we look at our finances, whether we're making $18,000 a year or $180,000 a year. So we have to have a change in our appetite. We have to think about how we're managing the money. Budget for some people is like a bad word. It's like dating the IRS. But there is no successful business entrepreneur, I don't care who they are, that don't have some type of budget. They may not call it that, but they have one. And so it is not how much money we make, it is what we do with the money that we have. It is how we manage it. If we can only afford to share an apartment with somebody, then we need to go share an apartment. Unlike some of us, well, I'm only making X, but I think the term is flossing, so people can think that I'm all of that. I'm going to go get this place that's going to cost me Y. And unfortunately, Paul, they're not going to honor the 12-month lease, because they're going to pay it a few months. And after a few months, they're going to be deuces, I'm out. They're going to jack up their credit, and then they're going to try to figure something else out. So it is about managing the little that you have to get to what it is that you want to be. The millionaire next door, it doesn't mean that you're going out and buying a $1,500 dress when you know you can't afford it. Or you're going out and buying a $5,000 handbag and you can't put $5 in the handbag. It is about setting priorities about where you want to be, but knowing that you got to sacrifice to get there. So you can be making $25,000 a year and be better off than the person that's making $70,000 a year. It all has to do with how you've conditioned your taste buds and your financial behavior to manage the dollars to get to where you want to be.
Thank you, Muriel. I heard some key things in there, but behavior and discipline is one of those key things. I want to turn over to Paul because I know with TIAA Institute, there may be some things that are going on there, but when retirement seems so far away, why should someone get started saving, and how do they go about doing that?
Well, ironically, the answer is in the question. Why should I start saving for retirement when it's so far away? I should start saving retirement because it is so far away, is the answer. And I'm not, honestly not trying to be glib there. Point is, when you're young, take it all the way into your 20s. Well, I'm at the point of life where my earnings are as low as it's going to be in all likelihood. And I have all kinds of needs starting out and maybe student loans, etc. So yeah, the money's not there, but who cares? I'll get to it later. Well, what I am rich in at that point in time is time. I have decades on my side. And what I'm taking this is even saving a little bit on a regular basis, starting at that early age, talking about compounding. And again, one of those basic fundamental financial concepts that people need to know the specifics of it, but just understanding how is something earning money, earning interest over time, and how it exponentially grows. And the vast bulk of that growth occurs in those out years when you start early. So that's why you want to start saving early, because what you're rich in is time, and you're leveraging that. And the place to look is first is at work. For most people, not everyone, you'll have access to a retirement savings plan on the job, 401k, 403b, whatever, depending on the nature of your employer. If that exists, that's what you want to use because of the tax advantage. And because in many cases, your employer will match some of the money you put in. And what I mean by that is they may have a policy where we'll match dollar for dollar the first 5% you put in. Well, that means if I put in 5%, de facto 10% is in there automatically. That's 100% return instantly. Nobody's ever been able to show me anywhere else where you can get 100% return instantly that then compounds from there. Or maybe they're matching 50 cents on the dollar up to 6%. If you put in 6, that means there's a total of 9 going there. Again, in this case, an automatic 50% return. That's something nobody should be passing up. At least put in the amount that's matched. Carve that out of the budget that Odingas was talking about. That's a must do. You can't pass that up. And then, work on debt payments or whatever, as well as you got to be saving for the near term, for the emergencies, for the fun things that you want to take, a vacation or what have you. You can't decide next year, hey, I want to take a vacation down to the Keys or whatever, and just do it and rack up credit. Yeah, you could do that. That's not smart. Be saving over time to get there a year from now, if that's what you want to do. So you got to have plans, and then you got to execute on it. But saving for retirement when it's so far away, that's exactly why you do start saving for it, because it's so far away.
Michelle, if I could add to that and add to that with Paul, is I think because part of this, what we're talking about is behaviors based on what's going on in the family. And saving for retirement should actually be a family thing. One of the things, particularly in Black and brown families, that we don't talk about is when your child is cutting grass, if he has earned income, did you know that he could be start putting a percentage of that money into an IRA up to the amount of the earned income? Imagine if we were teaching our children to start saving for retirement when they're cutting grass or purchasing stock versus going out and buying some Nikes and making it a family event as we're showing them how these behaviors are going to break the generational curse of poverty.
You bring up some great points, Muriel, Paul, and Odingas, and we started to get in some questions from the audience, so I do want to address those. But really, if we hone in on some of the key things that I heard the panel say, it's save as a family, figure out how to save for retirement. And one of the things that I want to add is don't think that it's too late to get started. I think those are some key things that I heard, and many other nuggets of information. So one of the questions that came in from the audience was this. They think that financial literacy should be taught in schools at all levels, because we all need to know how to manage our finances. So what are your thoughts on and advice on educating our youth about finances? And I think, Mira, you kind of touched on it with the young person that may be doing something in their home. They may be cutting grass or what have you. But for our other panelists, what other ways do we think that we can start to have this conversation with our young people, and any advice that you can share?
I think the reality is that more and more states, more and more school districts have a graduation requirement of a financial literacy course of some sort. So, you know, several decades when I was in K-12, you know, that wasn't even a passing thought. So the reality is that it's there. You know, I'm sympathetic to teachers who are responsible for more and more and giving them one more thing to teach that maybe some of them aren't comfortable doing. So you got to provide them with good tools, good content in those courses, and you know, it has to be, frankly, engaging to the students and an opportunity to put into practice some of that immediately definitely helps. Boys, unfortunately, you know, grew up, you know, with the nerdy financial sector dad. So what Mira was discussing, I offered them matching money, you know, if they would save, you know, some of their allowance or later on their earnings. You know, he said, "You're bribing me." No, I'm not calling it bribe. This is the real world. This is what I have at work in my plan. It's a match. You choose. Well, do I take advantage of it or not? And of course, then I wouldn't let him touch it, you know, for a year. It wasn't a retirement fund. Didn't lock it up forever. But giving kids an opportunity, either real world or, you know, frankly, gamification now in different, you know, electronic modes is another way to practice this and internalize it. And that's another great resource too.
All right. Thanks for that. I'm going to move to the next audience question and we can add some more context to this. I will also say in the education space and in all ages, there is financial education curriculum for all age ranges. My office provides it as well as some of our federal partners as well. So we can share some of that information to the participants, and we'll put some information in the chat. Also, Mary, I'll put this to you because you are the host of Champagne and Credit. So this next question that came up from an individual is they're carrying debt and they're trying to decide whether or not to pay down the debt or withdraw money from their 403B to remove the debt. They're at the age of 59 and a half. How do they decide? It seems I'm trying to get through the question, but really, do you take money out of your retirement to pay down credit card debt? What are our thoughts on that?
Not necessarily. You need to look at the overall situation, but the last place I would say for anyone to do is go to their 403B. When you're looking at eliminating debt, the first thing I tell people, and this is a process that I particularly am passionate towards, is that you categorize the debt. You look at what the debt is. You rank the debt based on the interest rate that's being charged and the term. You tackle the highest interest rate items first, and then you go down the list. You start making sure that you're paying those payments on time. There's no such thing as paying late, and don't think about the grace period, because the grace period is only a way for a lender to make more money. It is not helping you out at all. And then you look at eliminating that debt one by one. You're 59 and a half, you're looking at getting ready to retire. You need to make sure you have as much of a nest egg as possible to move into retirement. And they generally say that it needs to be a certain factor, and Paul can give you that number because he's the researcher, times what your normal income is. You're going to need housing, you're going to need health care. And then there's also this opportunity that most people don't talk about. If the debt is such that you're not able to sleep at night, then then there is a tool, and that tool is bankruptcy. Most people that teach financial education don't talk about bankruptcy, but bankruptcy is a financial tool. It just needs to be used with maturity. But the last thing you want to do is start dipping into your retirement to pay off credit card debt. Because one thing that happens when you retire, you ain't got a check coming in every 2 weeks. You got to live off of what you save and what you're getting in Social Security if you're not an old-time government employee. Then even more than that, sometimes we can be our worst doctor. A doctor shouldn't take himself for a patient. So you need to sit down with a certified financial planner or a financial coach. Michelle's office has a list of nonprofit organizations that provide the right information on debt management. Meet with one of those financial counselors, help them and meet with them. They'll help you put together a plan that would not include liquidating your 403B to get rid of credit card debt.
Thank you for that very solid advice. And one last question, because I want to make sure we stay on time. And I think this actually will attend to some of Odinga's comments and thoughts is, what can someone who has little disposable income do to grow their finances over the course of 3 years?
I would say they can start small. So, for instance, there are some financial apps out there that they can download. Anyone who is not making that much money, maybe minimum wage, you can start small, invest in small, buying fractional shares, using apps like Cash App, Webull, Robinhood. You can even start learning how to invest slowly but surely, just buying fractional stocks. And while you buy the stocks that are at a fraction, you can also earn fractional returns over time. Of course, you have to do your own research, you have to be patient, and you have to be disciplined and consistent. And I believe if you continue to invest that way over time, you will learn how to transfer that knowledge into other investment vehicles for your own discretion.
Michelle, if I can add to that.
Okay.
So if you've got a little, and if I can just add to that, if you're working with a little bit of money and you want to figure out how you're going to grow your financial position in 3 years, a couple thoughts. One, if you've got credit card debt, eliminate it. That's the best way to give yourself a raise, other than participating in a company-sponsored 401k or 403b. Eliminating your credit card debt, particularly double-digit credit card debt, will put money back into your pocket. Make sure you are investing in an employer-sponsored retirement plan. And then look at how you are living. And if you look at those 3 factors, because first of all, a lot of us want quick money because we want to invest and we want to get in the stock. And I've talked to a lot of people. I want to get into the stock market game. I was like, how much you got in credit card debt? Because if you got credit card debt and you pay 18, 21% interest, you do not need to be buying stock. What you really need to focus on is eliminating that credit card debt. Because anything that we put into the stock market is not insured. It is money at risk. Sometimes you win and sometimes you lose. So making sure that you've got a solid foundation first. Paul talked about it. And Odingas, I'm with you because we need to have a diversified portfolio. But first, don't leave money on the table. So if you got an employer-sponsored retirement plan and you're working with a few dollars, make sure, first of all, if they're going to match you dollar for dollar up to X%, take every dollar they're going to match up to X%. If you got credit card debt and you paying Peter and Paul 18%, 21%, Stop paying them. Pay that stuff off. And then you have money to actually play with. And you'll see that at the end of those 3 years, you actually working with some Benjamins.
Thanks for adding that, Muriel. And I would also say, think about multiple income streams. That's one other piece that we didn't add to that puzzle. One of the ways to increase your finances is to, and someone else said it, is to spend less or make more. And sometimes making more can come in any of those ways that was discussed by our panelists today. So I want to thank you all for a very rich conversation. And with that, I also want to share some resources that are available to the community at large, offered through the Department of Insurance, Securities, and Banking. This is our agency. We have a mission to empower and educate residents on all financial matters, among other things, such as creating and cultivating a regulatory environment that protects consumers, as well as provide financing to district small businesses. But through our efforts, we have created Financially Fit DC, which is an online financial program where if you have questions about how to manage your finances, if you want to get some additional information and you want to learn at your own pace, this is a tool that's available to you. It's free and it's available through the District of Columbia, where we talk about making a budget, managing credit, buying a home, planning for retirement, and building wealth. You can easily access this tool by going to welcome.financiallyfitdc.com. There's a lot of things that we can cover during this conversation today. An hour is never enough time to go through all the things that people can go through and learn about their finances, but we wanted to make sure that we can start this conversation and people feel comfortable with it. So I really wanted to thank our panelists for participating today, for sharing your wisdom and knowledge with individuals on this conversation. With that, I see that our host has come back on screen, so I want to turn it over to her, but I also want to thank all of our planning team for all of their assistance as well. Raisa, back to you.
Well, I just have to say thank you so much to Michelle and to all of our panelists. It has been, as you said, so many good pieces of information coming out of this hour, and an hour is never enough time to cover all of the good points. But that is also why this is just the first of several conversations that we plan to have. There will be more Let's Talk Money seminars in the new year, and we will focus on specific topics, everything from looking at budgeting to looking at retirement planning, investing, seminars that are more focused for some of the topics that are relevant for our students, some of the topics that are more relevant for staff and faculty. So please be on the lookout, particularly those in the UDC community, for future communications and future events. I thank you all for your time today, including all attendees. Thank you so much, and we look forward to seeing you at future events. Thank you, everyone, and have a wonderful day.
Thank you.
Thank you.
Thank you.
Thank you, everyone.